Vibha Padalkar of HDFC Life Insurance. She believes that the company is going to see strong growth and strong profitability and is confident that they will continue to beat the industry growth. Listen in.
HDFC Life has always believed in the principles of strong growth and strong profitability. Market share is an outcome. Reason we are not only focused on market share is because we do believe that sometimes it leads to a lot more short-term focus on perhaps not so good quality business. So we will continue to beat overall industry growth, but not necessarily be too fast on whether we are number 2 or number 1 or what is the numbering in terms of profitability and as well as market share. I think that the market realizes a couple of things. One is that insurance companies have a much longer horizon in terms of everything that we do. And so most of our assets are held to maturity as against expecting to give a short-term return or a lot of short-term focus. Because longer term, the fundamentals of Indian macros are pretty strong. And worldwide we are seen as a very strong emerging market. So nothing's changed as far as that is concerned. Second is that the product innovation, especially the private sector life insurance companies, including HDFC Life, have been known for, especially in the last 5 years or so, means that the understanding of what insurance products can offer, which are different from only investment related insurance products as it was known earlier, is becoming more and more apparent. So protection is something that insurance companies are beginning to focus on, and we've been the market leaders in that space. Over the long term, yes, no reason why with the continued focus on protection, and this is all 3 tenets of protection, mortality, morbidity and longevity, we should inch upwards, taking a leaf off China's books. It will take some time, but the continued upward trajectory should continue. However, on a full year basis, this will straight line somewhat. It will certainly be higher than where we ended last year, but nevertheless rationalized. And this is again because we do believe in a balanced product mix, and you will see us exiting the year with a non-par portfolio in the range of about 35%. So we want to be firing on all the channels. That's number one. Second is that we want to continue to be known as a product innovator, and we have a few in the pipeline, and we are hoping that end of Q3 there are some more blockbuster products that we can take to market, which will be first of its kind. That's the second part. Third is we are known as a technology focused life insurer. So on that part as well, we have mentioned in the past that we've tied up with Ivy Camp, and we're looking at under our Futurance umbrella, we're looking at whole host of startups that can work with us in order to look at use cases, work out a proof of concept, and then for us to roll out in whether how we go to market, how we mine data, how we do risk management, the entire gamut. And we have 150 bots that are currently on. So continuing to forge on the technology platform. And fourth is how do we look at offering whole host of adjacencies. So whether it's in the pension space, whether it is in the life space, how do we go to the customer wherein there's a meaningful manner in which we can engage with him on adjacencies.